Stochastics is actually a technical indicator used to measure overbought versus oversold. Now there's another application that is really more for trend traders and momentum, and I'll go into that as well. But stochastics is actually a Greek word for random. And the belief, in my opinion, of the creator of this indicator, it was really that as prices go to a higher range or a lower range or get too far stretched, there is a reversion to the mean. And so when we look at this, up top is the stock chart, and each of those bars is a daily price bar. What you'll notice is right as that price is going, and really it's an 80 and a 20 scale down below, and when the stochastic line is above 80, it's considered overbought, and below 20, it's oversold. And so one of the things, if you look at the arrow on the top of the screen, this would actually indicate that potentially it could be a sell right there because it's getting into overbought territory. You'll notice though that the problem with this indicator as an overbought oversold or reversion to the mean is that stocks can continue to rise and continue to have that momentum and that buying swell behind them. And so in a little bit I'll talk about how you can actually use it as more of a momentum based indicator to capture large trends. Now I've mentioned here slow stochastics. Slow stochastics is just a slowed down version versus fast stochastics, and I think a lot of traders like to use this because it's smoother and less sensitive to near-term price changes. Now it's an oscillator and it's used to identify potential overbought and oversold areas using price history over a set number of periods. Generally the default is going to be 14 periods. But it uses a fast and a slow line referred to as the K and the D lines. Now high readings point to a closing price at the top end of the range and vice versa for lower readings. And while it's designed to identify overbought and oversold levels, as I mentioned, trend traders can use this by adjusting the settings to find potential breakouts. And actually some traders do use or look for crosses by the fast above or below the slower lines. So as we said, as a pure overbought oversold indicator, you'll notice that once again, same slide as before, when we get to see those stochastic lines above 80, that is considered to be overbought and more likely to decline than not decline. But here is what I think is an interesting way to use this, and it's more of a trend indicator. And so this is the same type of situation, but here you'll notice that instead of the 20 and the 80 lines down below, we've actually put a 40 line in. And up above, you'll notice that when it crosses the 40, now that's actually a buy instead of a sell indication. And you'll notice that this trend continued. Stochastic stayed high, remained high, as the stock continued to move higher and higher. Now the line that I have on that chart is actually just a plain old 50-day simple moving average. And so as a trend trader, I find that using this, the simple moving average of 50 periods along with a slow stochastic set to 1433 as the settings there, this gives you a nice entry point as a trend trader. So that's kind of how this is used, and hopefully this helps you out in your trading. Good luck, everybody.